Hello, Damien the Car Guy here. This video will be a few minute overview of helping you make your best financial decision when you purchase your next car, or hopefully. So some quick facts here. 84% of the people who purchase a vehicle finance, borrow money from a bank. In that stat, for new vehicles, $530 is the national average for a new vehicle monthly loan payment. $380 is the national average for a used vehicle purchase. Most people finance 5 to 6 years, which would be 60 to 72 months. National average on that is 68 months. So there are a few things that factor in when you finance a vehicle. First is if you have money down, do you have a trade-in? Is your trade worth more than what you owe on it or less? That would be called negative equity in the car industry. And then the biggest factor in your monthly payment would be what your credit score is. Seeing that 8 out of 10 people that purchase vehicles also finance those vehicles. If you have a trade-in, that's great. If you have money down, that's great. If you have poor credit, most lenders are going to require that down payment or a trade-in that is worth more than what you owe on it, hopefully. Now, if you do have debt and that debt carries a higher interest rate than what your auto loan payment would be, or the interest rate on your auto loan, you're better off taking your down payment and applying it towards those credit cards or bills or loans. And if you have collections, typically the lower credit or credit challenged, those collections should be paid off before you really start the car shopping process, unless they're medical, like a phone bill or something like that you kind of get through. By paying those off, your credit score will improve, and it'll improve pretty drastically. With that improvement in credit score, that will lower your interest rate, or theoretically should, provided you give it the time to clear and your score to update. So on this screen, what we have here is an example of an auto loan, $15,000 selling price, add in your taxes, fees, take off a trade, that's $1,000, or a deposit. On the right side, we have a breakdown of some example loan rates, terms, kind of the great, middle, not so good. Now there are better rates, there are worse rates. This is just to kind of show you an example. These numbers here show the drastic difference in real cost of good credit versus bad, with everything in between. That low credit score, whether it's bad luck, poor decisions, that one new vehicle is literally costing someone with poor credit twice as much as somebody who's been financially responsible. If you're unsure of what your credit score is, you can use Credit Karma. The one thing with Credit Karma is it's an estimator, so it's not going to be your exact score. You can get your exact score from Experian once a year for free. So if you are planning on it, that's a great way to do it. Or if you want to just call a dealership for me, I can have a business manager pull your credit. We can let you know right where you're sitting. What should your monthly payment be? General rule of thumb is 20% of your take home. Let's say your household income is $50,000. Take home is about $3,300. That would put that number at about $650 a month for total loan payments. I'm a little more conservative. I probably would say $550 is a healthier max or cap to set yourself. If you have a car that's paid off, not giving you issues, keep it, great. Now, some folks will go to their own bank instead of doing it through the dealership. We do work with like 50 lenders, but some people have relationships established. In those situations, you can combine car loans to ATVs to boats. I typically advise against this because it's very hard to remove something from that combined loan. In essence, the bank kind of owns you at that point. So if you don't have to do it to get that lower payment, don't do it. Some lenders will go 7 to 8 years on an auto loan, finance an auto loan. Typically, I'd avoid this. The 5 to 6 years seems to be the sweet spot. You're not having monthly payments and bigger repairs or repairs. You're also paying less in interest. You're putting yourself in a position where if you want to trade, you can trade in 5 or 6 years. With that 7 to 8 year loan, you're really kind of pigeonholing yourself in. Now, if you do an extended warranty, a lot of people will extend the loan a few months, 5, 6 months, just to keep the payment the same and get the coverage. But as far as a generic auto loan goes, I wouldn't do the 7 or 8 year finance. If you can't afford the loan in 6 years, you're probably looking at too expensive of a vehicle. You can always pay more on your auto loan, but I don't know any banks that let you pay less. Typically when people come in shopping, I advocate newer vehicles, that 0 to 4 year range, 30,000 miles-ish. Reason being is those vehicles typically carry a lower interest rate, have lower cost of ownership as far as repairs go, more safety features for you and the family, more creature comforts, more tech, They're also going to bring a better trade value, you know, 5, 6, 7 years down the road versus something that might be 5, 6, 7, 8 years old currently. So if you have any questions about financing, buying, leasing, what your trade might be worth, generic questions at all, feel free to give me a call, text, email. All that info is listed throughout this video here. I'm happy to help. No pressure. So thanks for watching.